Hi, my name is Taylor Jaden with Financial Resource Advisors, and I'm one of the investment advisor representatives here. Today, we're going to go over some basics of investing. Some of you may be at different points in your financial journey, as so your financial knowledge. But regardless of where you stand, it can be helpful to get a refresher once in a while. There may be some specific details forgotten about over time. We're all here today because we know investing is important in order to reach some of our goals later in life. But one of the most frequent answers given about this topic is that the information about investing is just too difficult to understand. They either didn't know where to start or how to drill down deep once they did. Unfortunately, this is a fact. Investing can often seem confusing, and so it can tend to feel overwhelming. The financial industry has built up its own and admittedly made up language full of jargon and acronyms, and it can be really tough to decipher. So the goal today is to try and break down some of those terms and get you more familiar with them. We like to think of this in a cooking analogy. First, you need to get to know the ingredients, the pieces you'll be working with. Then you need a recipe, how to make them all work together, and finally, you need to start cooking, actually putting it all together. Let's dive into that first part. When you're cooking, you need to be familiar with the spices, oils, and other ingredients going into the dish you're trying to make. You need to know what you need to use to be successful. So let's get to know some of the building blocks to the investing recipe that we're working with. What makes investing so different from your normal savings? Why do we see them as two distinct things to do with your money? Put simply, savings is short-term and simple. Put your money away when you get it and just let it sit there. Investing, on the other hand, is more long-term. It takes a little more time and effort, but has the potential to make your money more robust. For example, rice is a staple to always have around and plenty basic, but with more time and effort, you can make it into something a little more healthy and flavorful. Savings are good for things where you need to know exactly how much you have available. Everyday living expenses, your emergency fund, even saving for a house. But it's not intended for far-off goals. That's where investing comes in. For goals more than a year out, that might even be 20, 30, 40 years into the future, the returns that investing can potentially offer become more important. Think of becoming financially independent in life and in retirement, or even helping to build a future for your children and other family members. Frankly, these types of goals just aren't really achievable by just putting money in a savings account. It all comes down to this silent roadblock we all face when trying to save for things we want to do: inflation. For any dictionary junkies out there, inflation is a measurement of the changes in prices of goods each year. You've probably all experienced this in your lives. Take going to the movies, for example. The experience itself hasn't changed much. Getting in, buying snacks, sitting in the theater, it's all essentially the same as it was in 1950. But over that time, the price of admission for a similar experience in 1950 and 2020 has ballooned from 46 cents a ticket to $9.16 a ticket. What inflation does is eats away at the value of our money. If you had $20 back in 1950, you could have bought 43 tickets, enough for you, your family, and a whole host of friends and neighbors. But in 2020, you'd be lucky to buy tickets for just you and a date for that same $20. Investing is a first step in the fight against the effects of inflation. The greater difference between how much our money grows and the inflation rate, the lesser impact it has on our overall wealth. To do that, we invest our money in a bunch of different things called assets. The two most common and basic investment assets are stocks and bonds. Owning these assets gives the potential of returns greater than inflation, but each is distinct. The first one, stocks, you may have heard of before and might be pretty familiar with. Owning stocks essentially makes you part owner of whatever company you bought stock in. Think of it as owning a piece of the pie. You share in the success and growth of the company, often in the form of dividend payments, the company splitting profits with you, and increasing the share price, making your initial investment more valuable. The second is bonds, which are slightly different. Instead of owning a piece of the company, you basically lend money to them with the promise of the company paying you back in full, plus a little extra for your help, known as interest. It might be helpful to think of bonds the same way as student loans or a mortgage, where a bank loans you money and expects you to pay back plus interest. But in the case of bonds, you would be the bank. Those are the basic ingredients at work here. Now, let's talk about sticking to the recipe and how these ingredients work together to give you the results you hope for. To put it simply, the key is in creating a diverse portfolio. You may have heard this term, diverse portfolio, before. We're going to dive deeper into it, but let's break it down really quick. A portfolio is just a collection of assets like stocks or bonds within an investment account. Diverse refers to that collection consisting of different assets, so not all stocks or not all bonds, or all one investment of each type, or all of something else. The recipe really starts with risk and return. Risk, the likelihood of losing money, and return, the potential money that might be made, are directly correlated with a higher potential to grow. There's also a high potential to lose as well. Each asset has its own unique risk and return profile. If you think of the assets we've talked about on a spectrum, stocks will have the highest potential returns on the upside, but also the highest potential for losses. With bonds, you may not make as much money as you would by investing in stocks, but you are also less likely to lose as much money as you could by investing in stocks. For that reason, any single bond you invest in will almost always be less risky than any single stock. Diversification is key to investment success. Because some assets zig when others zag, meaning different assets move in different directions from each other, stocks and bonds, for instance, are typically inversely correlated. If one goes up, it's likely that the other goes down. That's because each asset class has their own unique risk and return profiles. By combining different assets with different risk and return profiles in the same portfolio, we can use those counter movements to help offset the risk of each one and hopefully bring down the total risk within the entire portfolio. Diversification is so important because lowering your risk can be essential for the long-term success of your portfolio, even more so than trying to get the highest possible return. As losses mount higher and higher, the return needed just to break even, let alone gain money, becomes exponentially greater. It's a lot like a balanced diet. You need a good mix to stay healthy. Alone, each type of food group is missing out on nutrients that are provided by another. But by eating a little bit of all of them, we're able to get all the nutrients we need and decrease the risk of nutrient deficiencies. This all makes sense on paper, but it's really hard for us as humans to actually stick to. Our emotions can get in the way and cause us to go off course because diversified investing can seem boring and it never really feels like you're getting ahead. It can be tempting to put your money in an exciting, high-flying stock, especially if you're making less than the market in up years and still losing money in the down years. But the chance of successfully picking that one winning stock consistently over the entirety of your life are slim to none. That's why sticking to this recipe of diversification in your investments is so important. Even though it can seem hopeless in the short term, it can have a powerful effect over the long term. So make sure you keep your eyes on the long term and don't get distracted by the short-term movements that might derail your chances of success. So now that we're familiar with the pieces that go into investing, as well as the plan for using them, let's talk about how to actually start putting all this into action. It's time to get cooking. If you're sitting there saying, okay, I need to be diversified with stocks and bonds, so I should be good by investing in one stock and one bond, right? Well, the answer would be no. There are really two levels of diversification, across asset classes and within asset classes. We covered the former already, where you want different types of asset classes to offset each other. But in each asset class, there are thousands of options to choose from. Just think of the thousands of stocks out there. No one has a crystal ball, so if you pick just any one stock, it's impossible to tell if it'll actually make money or end up losing money, which happens often. What you want to do, instead, is buy some of every stock out there, so that if some lose money and the rest make money, they help to offset each other, just like with stocks versus bonds. But this can be very expensive for the average investor to do directly, so the most practical way to achieve this is by buying mutual funds and ETFs. In this way, mutual funds and ETFs have made investing easier for investors by giving them pre-packaged vehicles for investment, much like meal kits have done to make cooking easier in recent years. Both are similar with slight differences. Mainly, ETFs trade on the stock exchange and mutual funds do not. Both are pooled investments that buy a diverse set of stocks, bonds, or a mix of both for their investors in an easy package, fund shares. So, if you were to buy a broad market stock fund and a broad market bond fund, you would be naturally diversified both across and within those asset classes. Here's how they work. Let's take a hypothetical stock fund. There are more than 5,000 individual stocks to choose from. As I mentioned, this would be hard for someone to do by themselves. So the fund takes in money from lots of people, allowing it to have a pool of money large enough to buy a lot of stocks. In exchange, they give you shares of the fund, like shares of a stock. The people managing the fund select which stocks to buy based on their own analysis, typically mutual funds, or based on a list of stocks based on certain criteria known as an index, typically ETFs. This number is typically at least 20 and could be as much as all the stocks available, over 5,000. Your fund's share value is based on an average value of the underlying stocks that the fund buys. As the majority of those stocks go up or down, so does the average, and so does your fund shares. Importantly, start on this today. Some common remarks we hear is that, I don't have enough to get started, or I don't think that now is the right time to get invested. But those self-imposed hurdles only become harder and harder to overcome every day you wait. The sooner you start, the less you need to invest in each month to reach the same goal. The power is in compounding interest. As you add more and more money over time, the returns on that money will keep compounding off of each other, and the larger the pool gets, the more dollars it translates to each time. If you had 50 years to invest, it would take just $60 a month to retire at 65 with $1 million. Not only that, but it would only take a total investment of $36,000 to get there over that entire time period. If you compare that to waiting just 10 years to start, that same $1 million would cost $160 a month, and the total would be nearly twice as much. From there, the numbers only get bigger the longer you wait, so every day counts. We talk about investing monthly because doing so has the potential to help you take better advantage of fluctuation in market prices. This method of investing is called systematic investing or dollar cost averaging. If shares in your investment go down, you're able to buy more shares with the same amount of money that month. If it goes up, you can buy fewer shares, but you made money on your existing ones. Let's say you're investing your $60 a month into an investment that starts by costing $60 a share. Over the course of this hypothetical year, you would have purchased 14.1 shares for an average price of $51.06 a share. If you had invested that total amount of money all at one time at the beginning of the year, that $720 would have only yielded 12 shares for an average price of $60 a share. By investing all at once, lump sum, you would have made less of a gain over the year, $72 versus $210.60, and you would have fewer shares owned to grow in the future. You can't just go out and buy mutual funds and start systematically investing. They need to live within an account somewhere. As we mentioned at the beginning of this presentation, investing is best for long-term goals. Luckily, there are a lot of different choices of investment accounts available, each tailored to be uniquely suited to helping you achieve different goals. We're going to dive into a few of the most commonly used so that you're familiar with them. Taxable brokerage accounts, individual retirement account or IRA, 401k, 403b, and 529 accounts. The first one is the simplest, a taxable brokerage account. They work really similarly to a normal savings account at your bank. You take money that you have available and deposit it in. The difference is that, unlike a savings account, a brokerage account lets you take that money and buy investments such as stocks, bonds, mutual funds, etc. within the account. However, note that there are considerations to make when withdrawing the money. Unlike your savings account, if you made money above the amount you initially invested and withdraw some of it, the money made is subject to capital gains taxes and also might be affected by income taxes and change your income tax bracket. For this reason, this account is really good for general wealth building. No single specific savings goal in mind, but the desire to grow your money for things where you might need easier access to it than some of the other examples we'll discuss. One of those is an individual retirement account or an IRA. An IRA is a special type of brokerage account that is meant to be focused solely on saving for retirement. You can only contribute up to the max allowed with either pre-tax, traditional, or after-tax, Roth, money, or a combination of both, not totaling more than that maximum. If you're aged 50 or above, you can contribute an additional amount referred to as a catch-up. To help incentivize this, the government allowed them to have specific tax advantages, waiving taxes on the money going in or the money going out, depending on the contribution type. But this would be too good to be true without some restrictions. If you contributed tax deferred via traditional dollars, you must start taking withdrawals every year starting at age 73. You can make withdrawals for both traditional and Roth earlier, of course, but if you do so before the age of 59 and a half, then you are subject to an extra 10% penalty on the money coming out plus whatever taxes may apply. Employer-sponsored retirement accounts may be ones you're relatively familiar with. In the form of 401k or 403b plans, there are others. 401ks and 403bs are a lot like IRAs, with some key differences. First, the contribution limits are much higher. Also, contributions are made automatically from your paycheck before you get it. Also, withdrawals are mandatory at age 73 for both traditional and Roth contributions, instead of just traditional for IRAs. But most notable are these things called employer matching contributions. Not every plan has them, but if yours does, make sure you're aware of this and the specifics to your plan. Essentially, what these are is a certain amount of money based on a percentage of your contribution that an employer puts into your plan for free just for contributing that amount. I want to dive into this benefit since this match is essentially free money for you to put toward your retirement. The only thing you must do is enroll in your plan and make contributions, but if you can, make sure you also try to get the maximum amount available. So, if you contribute 2%, they contribute 1%. You do 3, they do 1.5. This goes up to 8, where they contribute 4. Any percentage above 8%, they will still contribute 4%, but the incremental increases stop. If you contribute 9, 10, or 11 plus, they will only contribute the 4%. So, making sure you hit that maximum match is important, because if you don't, you're basically leaving free money on the table. The difference between contributing 7% and 8% isn't just a lesser amount that you put in, but also an extra $500 a year if making $100,000 a year and with this plan. If that might be too much for your circumstances, then getting as close as possible to meeting that minimum number is the next best thing. Don't say no to free money. If you remember compounding, every dollar can have an effect on the end result. For retirement accounts, you may be wondering what the difference between pre-tax or traditional and after-tax or Roth contributions are. It's pretty much how it sounds, but there are implications that you might need to consider and decide between. With traditional or pre-tax, your contributions are subtracted before taxes are applied to your income. So you take your full income, subtract your contribution amount, calculate taxes on that new, lower income, and then you have your take-home pay. With Roth, or after tax, contributions are subtracted after taxes are applied to your income. You take your full income, calculate taxes on that income, then subtract your contribution, and that's your take-home pay. Typically, you'll wind up with more take-home pay now through traditional contributions than you will through Roth contributions. Because your taxes are based off a lower income, you lose less to taxes, but since you didn't pay taxes going in, withdrawals for traditional are going to be taxed while Roth won't. This means that you might be able to withdraw more with Roth than traditional. Determining which one is worth it depends on your tax bracket now and your expected tax bracket in retirement, and should be discussed with a licensed financial professional who can help you analyze that. One thing you should be aware of with employer-sponsored plan, you will always have some money in traditional dollars if you are receiving matching contributions, even if you chose to make all your contributions with Roth dollars. That is because employers' matching contributions are always made with traditional money. In instances like that, where there are both traditional and Roth dollars in an account, it's like having two buckets within one account. There's no difference between them in how they work in the account and grow. All the buckets do is separate them for tax purposes. Your plan provider will keep track of this for you. College is another big expense a lot of families try to plan for. The cost of sending your child to college is more expensive than ever and will only continue to be, and you can't always rely on financial aid. This is where accounts like 529 plans can help. They allow you to contribute as much as you want every year, invest it in normal investments like mutual funds, and have it grow as your child gets older. Then, when you're ready to spend it for college, you can withdraw as much as you want each year for qualified school-related expenses. Don't worry, there is a list available, completely free from federal taxes and sometimes state taxes. Make sure to check the list of qualified expenses. Non-qualified spending is taxed and incurs an additional 10% penalty. You can even use the account to pay for K-12 education, with up to $10,000 in withdrawals each year being tax-free. You can withdraw more, but any amount above that threshold is taxed according to your income. Each state has a number of different options of plans available through different providers, and an investor in one state can invest in almost any other state's plan. But if you plan to invest in a plan within the state you live in, it typically comes with the benefits of additional tax credits come April. While these plans can also be used for some expenses for the K-12 years, it's more commonly used for college because it allows for more time for the money in the account to grow. And if you end up not using the full amount for the intended beneficiary, don't worry. You can transfer the assets to another eligible family member of any age, withdraw the money for any purpose, although that will be considered a non-qualified withdrawal, or roll up to the predetermined max into a Roth IRA for the 529 account's designated beneficiary. As mentioned before, there are types of accounts that might better suit your specific needs. A licensed financial professional can explain these more in depth than we have time for today and help you compare them and determine what might be best for you. So, hopefully that leaves you with a good starting point for getting invested. We took you through the ingredients to investing: stocks, bonds, and inflation. Then we discussed the recipe to follow via a diversified portfolio. And finally, we talked about how to start cooking by systematically investing in mutual funds and ETFs across different types of accounts depending on your goals. But if I had to leave you with one thing, it would be this: get started as early as you can, right away if possible. Getting started can often be the hardest part of any difficult task, but think of it like Thanksgiving or any holiday meal. In order to make it successful, you need to get started cooking early. If you have everyone coming for dinner at 4 p.m., starting your turkey at 1 p.m. might be possible, but it'll be a lot harder to succeed. But if you start at 10 a.m., your odds of having everything done and cooked perfectly go up exponentially. It's important to have a sense of urgency about this. Make sure you have a plan now for how to get started and talk to a financial professional if you need some help diving down into the complexities. That's what they're there for. Thanks for taking the time to learn about the basics of investing today. If you have any questions, please reach out to FRA.